Hey, I'm looking for an investor center.
So let's talk about a word we hear all the time.
Investing.
Investment.
Investors.
Investment.
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 Investment. It's the golden ticket phrase marketers use to justify every price tag. Suddenly, that new phone isn't just a gadget. It's an investment in your productivity. That overpriced gym membership, it's an investment in your health. Like literally everything is an investment these days. The line between a real investment and a cleverly marketed upsell keeps getting blurrier. Companies have figured out that if they can slap the label investment on something, they can charge you more for it. Want a slightly better laptop? Double the price, because it's an investment in your future. A designer handbag? It's not just a bag. It's an investment in your confidence and personal brand, right? The truth is, the concept of investment has been weaponized against consumers, pushing us to justify spending more on things we don't always need. And the game is working, because who doesn't want to feel like they're making smart choices? The problem is, the market isn't just charging you for the product anymore. It's charging you for the illusion that buying it will somehow improve your life, while in reality, it's just another overpriced product. Over the past few years, the meaning of investment has undergone a remarkable transformation. What used to signify careful, strategic financial decisions aimed at long-term growth has been co-opted to describe everything from speculative luxury purchases to collectibles like trading cards and designer handbags. The shift reflects a cultural and economic moment where nearly everything can be framed as an investment, an idea that's often more persuasive than practical. An investment is about allocating resources, money, time, or effort to generate future benefits. Stocks and bonds remain stalwart options. For instance, the S&P 500 has delivered an average annual return of approximately 10% over the last century, cementing its place as a cornerstone for long-term investors. Bonds, while offering lower yields, provide stability in turbulent markets, making them an attractive counterbalance to equity investments. Real estate follows closely, promising consistent appreciation and potential passive income streams. These options, however, require patience, discipline, and often substantial capital to make a significant impact. Traditional investment avenues are designed for incremental, compounding growth, but for those who lack the resources or time to wait decades for returns. Cryptocurrency, for instance, exemplifies this trend. Bitcoin surged from being practically worthless in 2010 to peaking at over $60,000 in 2021. While such returns are alluring, the volatility is undeniable. In the first half of 2022 alone, the crypto market shed over $1 trillion in value. Luxury collectibles like watches, rare wines, and trading cards have joined the ranks of speculative assets, with markets seeing explosive growth followed by sharp corrections. What's driving this shift toward alternatives? For one, their appeal lies in their detachment from traditional markets. Wealthy investors often turn to commercial real estate, private equity, or even commodities like gold to hedge against economic downturns. Unlike stocks that can plummet during a recession, these assets often retain or even gain value. For instance, during the 2008 financial crisis, gold prices soared by over 20% as investors sought stability. Another reason is control. Unlike a diversified stock portfolio where investors are at the mercy of market forces, alternative investments like art or real estate offer opportunities to enhance value. Renovating a property or promoting a piece of artwork can significantly increase its market price. Alternative markets are less saturated with competition. Alternative spaces remain more accessible to savvy individual investors. But the flip side of this appeal is risk. Alternative investments often come with illiquidity, high costs, and niche markets that lack transparency. A prime example is the luxury collectibles market, where auction houses like Sotheby's charge commissions as high as 20%, eating into profits before a sale is finalized. Illiquidity poses another problem. Finding a buyer for a rare painting or collectible handbag can take months, if not years. Still, the allure persists, largely driven by speculative enthusiasm. During the pandemic-era economic boom, luxury goods and collectibles were touted as foolproof investments. Watches from brands like Rolex and Patek Philippe, along with high-end handbags, became cultural symbols of responsible spending. The promise was simple: buy today and sell tomorrow at a premium. But when these markets cooled, many investors were left holding assets worth far less than they paid, exposing the fragility of hype-driven markets. This new wave of speculative spending has been further fueled by the cultural narrative of scarcity. Brands intentionally limit production runs to create exclusivity and drive demand. Luxury items are marketed as limited opportunities to own a piece of prestige, enticing buyers with promises of future appreciation. In reality, these tactics serve corporate profit motives, not the financial well-being of their customers. Even as traditional and alternative investments coexist, the term investment itself has evolved into a catch-all justification for spending. Everything from high-end cars to Pokemon cards is framed as a savvy financial move. Yet many of these so-called investments are, at best, speculative gambles. They're marketed to consumers hungry for a sense of control over their financial destinies. But too often, they lead to disappointment when market realities set in. While traditional and alternative investments offer genuine opportunities for financial growth, the mass market adoption of the term investment has spawned a dangerous lie.
I lied.
This lie persuades consumers to spend exorbitantly on products or trends under the pretense that they're not spending, they're investing. From luxury goods to speculative assets, this narrative thrives on half-truths, inflated expectations, and the psychological allure of exclusivity. The most glaring example lies in luxury goods marketed as investments. High-end watches, designer handbags, and limited edition cars have been elevated beyond mere products to symbols of financial acumen. Brands like Rolex and Hermes actively promote scarcity by limiting production, creating artificial demand. This strategy inflates resale prices, giving the illusion of long-term appreciation. For example, during the height of the 2021 luxury boom, some Rolex models were selling for 50% above their retail price on secondary markets. Yet, as the market cooled in 2023, these inflated prices collapsed, leaving latecomers holding the bag, literally and figuratively. The lie is bolstered by anecdotes of rare successes. Stories of individuals who flipped a $15,000 watch for $30,000 dominate social media and finance circles, overshadowing the far more common reality of stagnant or depreciating assets. Platforms that track the value of luxury goods, like Watch Charts or StockX, amplify this perception, framing these products as viable investment opportunities. But the truth is, these platforms are often tied to the resale ecosystem, profiting from the very transactions they claim to analyze objectively. Cryptocurrencies offer another cautionary tale. Once heralded as the democratization of finance, crypto has been mired in extreme volatility and speculative mania. While Bitcoin and Ethereum have made some investors extraordinarily wealthy, the broader crypto market is rife with pump-and-dump schemes, rug pulls, and unregulated tokens that collapse overnight. For every person who bought Bitcoin at $1 and sold it at $60,000, there are countless others who bought at the peak and saw their investments evaporate. This speculative fervor isn't limited to luxury goods and crypto. The rise of NFTs brought with it promises of digital art and assets as the next frontier of investing. NFT sales exceeded $25 billion in 2021, with some individual pieces selling for millions. But by mid-2023, the market had imploded, with the average sale price of an NFT plummeting by over 90%. The bubble burst because the value was never tied to intrinsic worth, but to speculative hype, a common thread in the investment lie. What makes the investment narrative so compelling is its emotional appeal. People are naturally drawn to the idea of financial freedom, and investments, real or imagined, promise a pathway to that dream. Marketing strategies tap into this desire, using phrases like limited edition, exclusive drop, and future-proof to create urgency and justify high prices. Psychological principles like FOMO and the sunk cost fallacy further entrench consumers in the belief that their purchases are not just products, but stepping stones to financial security. The implications of this lie are far-reaching. On an individual level, consumers are saddled with debt, buying items they can't afford, under the assumption that they'll hold or increase in value. On a societal level, the normalization of speculative spending exacerbates economic inequality. The wealthy, who can afford to dabble in alternative investments without jeopardizing their financial stability, can play these markets with little risk. Meanwhile, middle and lower income individuals, lured by the promise of quick gains, are often left worse off. This disparity is particularly evident in markets like real estate, where institutional investors snap up properties as investments, driving up prices and pushing homeownership out of reach for average families. But the most insidious aspect of this lie is how it erodes trust in legitimate financial planning. When the narrative equates buying a $5,000 handbag with investing in an S&P 500 index fund, it trivializes the principles of disciplined saving, diversification, and long-term planning. It shifts the focus from wealth building to conspicuous consumption, encouraging people to prioritize status over substance. So how can you resist the investment lie? The first step is understanding the difference between speculative spending and true investing. Genuine investments are tied to underlying assets with intrinsic value or cash flow potential. Stocks represent company ownership. Bonds are loans to governments or corporations, and real estate provides utility or rental income. Speculative assets rely solely on market sentiment and scarcity, making them inherently unstable. You should also approach luxury goods and alternative assets with a healthy dose of skepticism. Ask critical questions. Is this purchase supported by intrinsic value or hype? Can I afford to hold this asset if the market turns against me? Am I buying this for its utility or because I believe someone else will pay more for it later? Financial literacy is crucial. By understanding the fundamentals of investing and recognizing the psychological tactics used in marketing, you can make informed decisions and avoid falling prey to the investment lie.